Hello, my name is Peter Hughes and welcome to this lecture on ESG, sustainability and accounting reform. By way of introduction, I'm the chairman of the Risk Accounting Standards Board, or RASB. I'm also an English chartered accountant, and during a 25-year career at JP Chase, initially on the Chase Manhattan side of the house, I held country, regional and global executive positions in finance, risk management, treasury and trading, operations and internal audit. Since 2003, I've run my own consulting and executive training business, and in 2017 I was invited to join the faculty of the Durham University Business School as a visiting fellow to lead research into risk-based accounting methods and systems. In 2017, the Risk Accounting Standards Board was formed, which is a not-for-profit organisation set up as a placeholder for the outputs of ongoing research at the business school. In its present form, RASB is a research partnership. In 2022, a joint initiative on accounting reform was formed that brought 4 organisations together. In addition to RASB, there's the Association of Chartered Certified Accountants, or ACCA, the Professional Risk Managers International Association, or PREMIER, and the Durham University Business School. This lecture explains why we believe accounting reform is necessary and introduces a new branch of accounting we're calling risk accounting. In recent decades, companies have experienced exponential growth in the size and complexity of their exposures to non-financial risk. They include a host of different risk types: cyber, climate change, supply chain, manufacturing, transaction processing, conduct, fraud, geopolitical, model, legal and compliance, and I'm sure there are many more. We've seen how unquantified and unreported accumulations of non-financial risks pass a tipping point when they mutate into realized and sometimes life-threatening financial losses, euphemistically termed unexpected. Rogue traders, the UK's Payment Protection Insurance or PPI scandal, JP Morgan's London whale, the various forms of cyber attack, and high-impact systems upgrade and implementation failures are all examples. Unexpected losses are a CEO's and CFO's worst nightmare. Without warning, they can put a severe dent in or even wipe out shareholders' equity altogether, notwithstanding the reputational damage. Spare a thought for JP Chase's CEO and chairman, Jamie Dimon. In 2012, reports began to surface about the unusual and aggressive trading activity of one of JP Morgan's larger-than-life traders the market had dubbed the London whale. After taking counsel from his senior executives who assured him the London whale's trading position was basically squared, with no material exposure, Mr. Dimon publicly dismissed media reports as a tempest in a teapot. Within a few months of that dismissal, he found himself sitting in front of a congressional hearing trying to explain a $6 billion loss. He later wrote of the affair, "Let me be direct. The London whale was the stupidest and most embarrassing situation I have ever been part of." And that's $6 billion worth of stupidity and embarrassment, and not many can afford that. The most egregious example of unexpected losses by far is the subprime fiasco that provided the backdrop to the global financial crisis of 2007-8. In the years leading up to the crisis, banks were reporting massive subprime-fueled profits while polluting the global financial system with toxic subprime waste, which, in 2007-8, mutated into financial losses that severely depleted the banking system's capitalization and even threatened global economic meltdown. The big question accountants need to address is, why do accounting standards tolerate the acceptance of material exposures to non-financial risks in one accounting period and the reporting of associated financial losses in a subsequent accounting period? This accounting anomaly undermines the confidence investors and other stakeholders have in accounting profit. This risk and profit taking now, losses later accounting also opens the door for less principled businesses and their employees to play fast and loose with investors, customers, the environment, public health and safety, and the well-being of communities. So, can this accounting anomaly be fixed? To see if we can answer that question, let's take a closer look at what we learned from the global financial crisis. I'll start at the beginning by going back to 1999 when the Basel Committee on Banking Supervision issued a consultation paper titled A New Capital Adequacy Framework, which was the forerunner of Basel II, also known as the Second Capital Accord. In it, banks were challenged to devote the necessary resources to quantify their level of operational risks and to incorporate them into their assessment of their overall capital adequacy. The banks failed the challenge on two counts with devastating consequences. First, they were unable to come up with a meaningful way of quantifying and validly aggregating granular exposures to operational risk. In fact, what emerged was something called risk and control self-assessment that colour codes exposures red, amber and green rather than explicitly quantifying them. Second, the elite banks lobbied the Basel Committee to authorise the use of their in-house models to determine minimum regulatory operational risk capital requirements. The Basel Committee ultimately succumbed, and banks' in-house models, collectively referred to as Advanced Measurement Approaches, or AMA, were formally adopted into Basel II as the preferred operational risk capital calculation method. And to guarantee an impregnable ring of protection against systemic risk, the Basel Committee mandated that AMA models should incorporate a safety parameter expressed as a 99.9% confidence interval over a one-year horizon, the so-called Basel Soundness Standard. Using admittedly simplistic shorthand, the Soundness Standard is intended to produce an amount of protective capital sufficient to buffer the largest loss that is likely to occur once in 1,000 years. Let me repeat that. To buffer the largest loss that is likely to occur once in 1,000 years. The fact is, within 5 years of the implementation of Basel II, we were in the midst of a global financial crisis. In 2007-8, banks around the world began to fail serially, triggering government bailouts, forced acquisitions, and even bankruptcies, the most well-known being that of Lehman Brothers. The AMA models and the Soundness Standard evidently failed to produce the intended effect. The 1,000-year ring of protection was breached within 5 years. Against this backdrop of failing banks, a 3-stage emergency program, coordinated by regulators and legislators around the world, averted global economic meltdown. In Stage 1, taxpayers' funds were used to recapitalize the banking system. In Stage 2, regulatory and legislative straitjackets were applied to banks to contain their more extreme risk-taking, most notably through Basel III and in the USA the Dodd-Frank Act. And in Stage 3, the Basel Committee removed AMA models from the regulatory framework. That last point, the removal of AMA models, was announced in 2016 in the following terms. The AMA's inherent complexity and the lack of comparability arising from a wide range of internal modelling practices has exacerbated variability in risk-weighted asset calculations and eroded confidence in risk-weighted capital ratios. The committee is therefore proposing to remove the AMA from the regulatory framework. The bank's failure to come up with a method of quantifying their operational risk exposures with any acceptable degree of precision effectively handed free rein to the regulators to impose whatever capital calculation method they believed would produce a regulatory capital buffer sufficiently large to mitigate systemic risk and guarantee the stability of the financial system. The result was a universally applicable standardized operational risk capital calculation method that uses proxies from financial statements and historic losses as indicators of the existence and likely scale of operational risk exposures in place of any form of explicit risk measurement. The method was intentionally contrived to produce oversized capital buffers that coerced banks into holding eye-watering levels of inert, unproductive and costly operational risk capital reserves, irrespective of the quality and effectiveness of their risk mitigation activities, processes and controls. So, boards, CEOs, CFOs and CROs are left to navigate their organizations through a veritable minefield of complex non-financial risks with a weak and ineffective operational risk management toolkit comprised of non-comparable and non-aggregatable color-coded risk and control self-assessments and an arbitrary capital calculation method devoid of any form of explicit risk measurement. A 2017 report titled The Future of Operational Risk from McKinsey & Co. and ORX agrees with this unfavourable conclusion. The report summarises the responses to a survey of chief risk officers from 15 leading financial institutions in the following terms. Many still described existing operational risk management information as backward-looking, shallow, not dynamic and hard to compare across the organisation, when what they wanted was information that was regularly available, comprehensive, comparable, action-oriented and forward-looking. Let's now return to the global financial crisis. The extreme subprime-fueled losses reported by banks in 2007-8 predominantly fell into two categories: credit risk and market risk. However, the cause was weak and ineffective internal risk controls that failed to prevent the creation and distribution of toxic subprime financial instruments across the global financial system. If a bank pumps massive volumes of new and highly complex financial products and trades through an operating environment that isn't prepared for them, the result will be accumulations of exposures to non-financial risk. If unaddressed, accumulating exposures will pass a tipping point when they mutate into realized financial losses. Said another way, any material, unexpected financial loss must have previously existed as a material, unquantified and unreported non-financial exposure, or to use more technical language, although I feel this is a statement of the blindingly obvious, accumulating non-financial risks and subsequent associated financial losses are positively correlated. But there's a difficulty here, which is probably best illustrated if we look at how credit risk models have evolved. Over time, credit risk models have acquired immensely powerful predictive properties. This was possible due to the availability of rich sources of historic credit data comprising details of credit defaults and the respective obligor's credit context at the time of default. The primary elements of credit context are a borrower's total exposure at the time of default according to accounting systems, and the risk ratings assigned by credit analysts, rating agencies, and/or credit scoring. These elements are labelled loss given default, or LGD, and exposure at default, or EAD. Historic LGD and EAD datasets are statistically correlated to predictively model with high precision the probability of default, or PD, of current individual credits and whole credit portfolios. If we turn our attention back to non-financial risk, we discover that the non-financial risk equivalent of credit risk's exposure at default is only available as three colours: red, amber and green, not values. That fact alone means that classic portfolio management techniques available to financial risks, including predictive modelling, simply aren't available to non-financial risks. So, what has the accounting profession contributed to the resolution of this non-financial risk conundrum that has tormented the banking sector and its regulator for more than 20 years? I'm afraid the answer has to be very little. Accountants would presumably argue in their defence that a non-financial risk is inherently unobservable. Only outcomes are observable, and you can't account for the unobservable. But this defence no longer cuts the mustard. The investor community and others have publicly announced their loss of confidence in the primary accounting measure on which investment decisions are based, which is financial profit, and are demanding it be replaced with a new measure, corporate sustainability. So, what do we mean by sustainability? There are probably many definitions out there, but the one we've adopted has an accounting bias, and here it is. Sustainability is an organization's capacity to provide investors with reliably predictable returns on their investment in financial, environmental, and social terms. Note the emphasis on reliably predictable. In other words, corporate sustainability in accounting terms is an organization's accounting profit or loss, which is the backward-looking or historic perspective adjusted for the expected losses associated with accumulating non-financial risks, reduced by the positive offsetting effects of ESG attributes, which is the forward-looking or future perspective. ESG attributes include the risk mitigating impacts of an organization's human capital, intellectual capital, business networks and relationships, environmental protection, and community well-being. So, in short, corporate sustainability is the blending of backward and forward-looking financial performance within a common accounting and reporting framework. The absence of accounting standards that address accumulating non-financial risks and offsetting ESG attributes has consequences. Most significantly, the default position of standard setters is to deal with these elements outside the financial statements in the form of narrative and/or statistical disclosures. So, when a new risk emerges that introduces the prospect of material investor-critical financial impact, such as climate change, the result is chaos and confusion because, and again I'm conscious of stating the blindingly obvious, it's impossible to standardize and audit narrative and statistical disclosures made outside the financial statements. The result is likely to be a costly bureaucracy imposed on organizations that fails to fully deliver corporate performance information with the consistency, clarity, comparability demanded by investors and other stakeholders. This is particularly the case if statistical modelling is providing the underlying metrics and statistics, given the evidence of the banking sector whose global regulator, despite more than 20 years of investment in such models, abandoned them due to their, quote, inherent complexity and lack of comparability. This conundrum was given full exposure in a recent open letter issued to the European Commission, the European Parliament and the Council of the European Union in October 2021. It was signed by 56 large, influential companies with operations in Europe, collectively representing over 8.5 trillion euros in assets and employing over 5 million people. Noteworthy is the fact that the 56 signatories to the letter include the Big Four accounting firms EY, PwC, KPMG and Deloitte. Here are two brief extracts. Sustainability needs to be integrated into accounting and reporting systems. Preparers and consumers of ESG data are still struggling with a profusion of reporting frameworks and standards that do not enable consistent and comparable disclosures. And this is from a December 2020 Harvard Business Review article titled "The Future of ESG is Accounting." The article describes the situation rather neatly. And it's worth noting that one of the authors is the Harvard and Oxford professor, Robert Eccles, who was the founding chairman of the Sustainability Accounting Standards Board, formed more than 8 years ago. There are still no universally adopted standards for how companies can measure and report on their sustainability performance. Instead, we have a large number of NGOs working independently to develop standards for sustainability reporting, which is creating complexity and confusion for companies and investors. While most companies today issue sustainability reports, these are divorced from their financial reports, making it difficult to see the relationship between financial performance and sustainability performance. Now, we know that the IFRS Foundation and the Global Reporting Initiative have announced their collaboration on the promulgation of universal sustainability reporting standards, but the concern is that the underlying assumption, when doing so, is likely to be that non-financial risks and offsetting ESG attributes cannot be explicitly quantified and accounted for. If that is the case, the default position will be the dissemination of sustainability standards exclusively focused on disclosure outside the financial statements rather than accounting within the financial statements. Okay, so that's the size of the issue. How will accounting reform address it? The proposition is that a new branch of accounting is called for that we're calling risk accounting. The mission of accounting reform is to conclude, based on empirical evidence, whether risk accounting provides a viable accounting-based foundation on which financial profit can securely transition to corporate sustainability as the primary accounting measure of corporate performance. So, what is risk accounting? It's a standardized and integrated non-financial risk management and accounting framework that identifies, quantifies, aggregates, values and reports all forms of non-financial risk and accounts for the expected losses associated with accepted non-financial risks, including the positive offsetting impacts of ESG attributes. This is the solution that has been codified and subjected to laboratory testing as an integral part of the 5-year research collaboration between RASB and the Durham University Business School. It isn't possible or sensible to go through a detailed exposition of risk accounting in this lecture, but here is a simplified overview of how the method is applied using the example of a bank. The first principle of risk accounting is that the reporting of non-financial risks needs a standardized, additive, non-financial metric. When we set out to codify a method of risk accounting, there wasn't a common metric, so we created one and called it a risk unit, or RU. That means monetary values, US dollars, euros, British pounds, etc., are used to report financial outcomes, and the RUs are used to report non-financial outcomes. So, this is how risk accounting works. Products are assigned risk factors from standardized tables called Exposure Uncertainty Factor, or EUF tables, according to the primary risks they trigger, which denotes each product's relative probability of causing expected loss. Note the labels attached to the principal risks are aligned to the operating environment, not the financial outcomes. That is, transaction processing, lending, trading, treasury, which includes funding and interest rate management, selling, and environment protection. The daily new business booked by each product, that is, sales or trading volumes and values according to accounting systems, is mapped to a value table, and a value band weighting is assigned denoting each product's probable severity of any expected loss. From the risk and value factors, an algorithm computes each product's daily inherent risk in RUs, which is the daily risk loading on the enterprise and represents the maximum possible expected loss before considering the risk reduction impact of the organization's ESG attributes, that is, its risk mitigation activities, processes, and controls. Risk and control self-assessments that compare the actual status of risk mitigation vis-à-vis industry consensus best practices are enhanced in risk accounting by replacing color codes with standardized and expertly calibrated numeric risk mitigation impact weightings. An algorithm computes the risk mitigation impact of each business component that comprises the operating environment. We call this the Risk Mitigation Index, or RMI. Business components are operations or production units, reference data sources, core systems, credit and other risk and quality control units, treasury and trading, and sales and relationship management. From the inherent risk RUs and RMIs of the business components that interact with a product on its end-to-end journey through the enterprise, an algorithm computes the residual risk in RUs of each product, which represents the actual amount of non-financial expected loss the organization has accepted. For those who want to do a deep dive into the method, there's a step-by-step walkthrough in my book, Where Next for Operational Risk, a guide for risk managers and accountants. The anticipated outcomes of risk accounting are threefold. First is blended quantitative and qualitative non-financial risk analytics that are aggregated along the horizontal and vertical dimensions of the enterprise. Second is a standardized accounting framework that accounts for and reports all forms of non-financial risk and ESG attributes, including, but not limited to, cyber, climate change, supply chain, manufacturing, transaction processing, conduct, fraud, geopolitical, model, and legal and compliance. Third is an auditable foundation on which accountants can risk-adjust accounting profit and shareholders' equity through accounting for expected losses. So, through risk accounting, we have effectively replicated credit risks exposure at default, or EAD, for non-financial risks. The non-financial equivalent of credit exposure is residual risks in RUs. The non-financial equivalent of credit risk ratings is risk mitigation indexes, or RMIs. Risk accounting enables the application of classic portfolio management techniques to non-financial risks. Importantly, 1. The statistical correlation of historic losses and residual risk RUs over time is used to refine the risk quantification technique embedded in risk accounting and ultimately derive the monetary value of an RU, while progressively enhancing the RU's inherent predictive properties. 2. A profit incentive is attached to risk reduction initiatives that increase RMIs and reduce corresponding residual RUs. 3. The group-level consolidated RMI is a composite measure of an organization's risk culture through blending qualitative and quantitative risk information from across the enterprise within a common risk measurement and reporting framework. Now, let me be clear. We are not claiming that risk accounting is a panacea for all sustainability and ESG reporting challenges. Rather, we see risk accounting as a line. On one side of the line are the sustainability and ESG reporting challenges that can be properly addressed by accounting within the financial statements, and the other side of the line are the sustainability and ESG attributes that can be more appropriately addressed through disclosures made outside the financial statements. The focus of accounting reform is to optimally position that line and codify risk accounting standards that, in line with the mission, provide a viable accounting-based foundation on which financial profit can securely transition to corporate sustainability as the primary accounting measure of corporate performance. For more information on the Joint Initiative on Accounting Reform, you can visit the website or email me at phughes@rasb.org. Thank you.